watching Stock Watch. I'm Zanati Kuma, and joining me to unpack your stock-related questions today are Chantal Marx from FNB Wealth and Investments and Grant Nader from Benguela Global Fund Managers. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X @BusinessDayTV using the hashtag StockWatch. Thank you so much for your time, lady and gent. There's so much that is happening. I don't even know where to start. We have Budget 3.0 coming up on Wednesday. I must say that I'm a little bit lazy to do that all over again. And of course, we also have the ratings decisions that have come from S&P and Moody's on South Africa and the US, and obviously a whole bunch of earnings. Just on the macro side, let me start off with you, Chantal. What will you be keenly focusing on this week?
Well, I think it's natural that I'll have to focus on Budget 3.0, but granted, I also have the same kind of budget fatigue that you have, and I certainly see that coming through from our marketing ladies at FNB as well. But yeah, we have to watch that closely. We have to see what impact the decision to withhold on a VAT increase will have on our fiscal consolidation efforts. At this point in time, we don't see that there is going to be much of an impact there, because the commitment really from Treasury is to continue to pursue fiscal consolidation and to really to have that primary budget surplus coming through for South Africa. So if anything kind of deviates from that expectation, I do think that we could see a big market reaction, but of course that's not our base case.
Yeah, and of course in the US, also lots that's happening. Grant, it seems like whatever's happening in the US now seems to have also turned everything on its head, where, for example, we saw the spike in the Treasury yields after Moody's downgraded the US. Is this something to be significantly concerned about?
I think not in the short term. I mean, there is a lot of macro movement at the moment, but if you think about it, there are no alternatives. There can't be a flight out of US bonds and USD denominated assets, because where they're going to go, there aren't enough liquid alternatives. The euro is only 25 or 30% of the USD index. So, you know, my view is this has happened before. We've had a downgrade before. There was a little reaction, and then the world sort of moved on. And that's, I suppose, the privilege of being the world's reserve currency. By definition, you're the reserve. So where they're going to go. So I think I wouldn't worry about that, but I do think that concern around the debt is behind some of these broader narratives and some of the noise that's coming out of the US administration, and all this trade and tariff war, etc. So it does paint the picture of what some of this noise is about and where they need to go to fix things. Whether we see that consolidation needed, you know, that's another question, because the tax cuts that they're talking about are significant, and I'm not quite sure how they're going to fund all of that.
Yeah. Well, there's been a flight from some of these assets, and quite an interesting question here is, are there stocks that you've been lightening on in the past week or days, and why? Of course, on the show, we talk a lot about adding onto your portfolio, buying stuff, stock picks, but actually never really what you are fleeing from. Chantal, are you fleeing from anything at this point?
I'm not really fleeing from anything at this point. I think what this volatility has provided us with is an opportunity to kind of reassess where we are currently and where we think the world is going. I think first and foremost, a place where we've been taking some profit off the table would be the gold mining trade. We've seen miners rally quite strongly. I wouldn't suggest exiting those positions right now, not with all the chaos that's still going on around the world. But certainly I think there are opportunities for to get cheaper entry points into stuff that used to be expensive a few months ago. And a really nice way to fund that would be to reduce your gold exposure. Another area where we've been reassessing have been the kind of the oil exposed stocks. I think oil services in particular have taken quite a knock, and I don't think that there's any pertinent reason to be invested in some of those oil support companies like Schlumberger and Halliburton and Patterson UTI. So also just kind of reassessing why we are invested in those stocks currently.
Grant, on your side, anything that you are offloading at this point? I mean, quite an interesting one that Chantal's talking about gold, and a lot of people have actually been wondering when people are going to kind of start taking profit on the gold stocks. Anything else on your radar at this point?
I mean, there's not a lot that fundamentally good companies that have run away from the fundamentals.
Okay.
So specifically in SA, if anything, they gave you a good chance to buy, as Chantal said, and they're worth more now, but they're not egregiously priced. Something like Capitec's run really hard. You could probably take some profits, but don't make the mistake of selling out of it. So that's the danger of the game of trimming, and then you forget to buy it back. So play that game carefully. I think gold is a very volatile asset, and you could maybe think about that. But also remember, what's your time frame? I think longer term, the fundamentals around why people are buying gold and the demand structurally has changed. If you look at central banks globally, the US dollar outlook, etc. So I think you can be short term in selling it, but long term, as Chantal said, there's a lot of noise in the system, and I think it still has a place in the portfolio. And perhaps stuff that's really cyclical, that's had a nice rally, if you bought it well, perhaps like some of the retailers, you could take a little bit of profit there. But outside of that, hold on to the good stuff. Don't be too quick to sell, because the global markets are 1% from all-time highs. It's almost like April 2nd never happened. If you had said to me a month ago, make me a price on the markets being back here post-Liberation Day, a month and a half later, it would have been very thin odds. So it's quite unclear where we go from here. So just hold on to the good stuff.
All right. Well, something that not a lot of people have been holding on to is Sasol. But actually, we do have a significant batch of Stockwatch listeners, viewers that are still into Sasol, hoping for good news. Tomorrow, I am having a conversation with the CEO. I think it's a capital markets day. Chantal, you were speaking about reassessing your reasons for being in oil-exposed stocks. With Sasol at this point, what do investors actually need to be looking out for?
So I think this Capital Markets Day is going to be quite important. A lot of emphasis is being placed on what happens to Sasol after 2030. They have some feedstock issues, some question marks around where they are going to go after 2030, and hope the management team will be able to answer that. Because what we've seen from a market pricing perspective is the market is basically pricing in that almost nothing happens after 2030. So the terminal value for that stock is extremely low. And once you can get some clarity on where they're going to go and perhaps what the operations are going to look like and where the growth is going to come from, then you can actually assign a higher terminal value to Sasol, and then you should see the stock re-rate. If you have a capital markets day tomorrow where there's not really a commitment towards the longer term picture, I think that will be very disappointing to the market and probably reaffirm the really depressed price that the stock is trading at currently. I'm not exposed to Sasol in a personal capacity, and I'm very happy to let it remain that way for now.
Okay. Interesting that you talk about basically the outlook that will be in focus, particularly after 2030. But I mean, how confident, Grant, can one be on the outlook after 2030 when things are not looking good now?
It's a good question, right? This is a structurally and fundamentally challenged business, and it has been for a long time. But I will say, in the low 60s, and we had this conversation on the show a couple of weeks ago, the risk-reward historically definitely skews in your favor. When things get so cheap, and there's so much bad news and everything points down, all you need is things to be less bad. So I would expect if the Capital Markets Day provides even the slightest guidance and the slightest potential for improvement somewhere, you might see an uplift in the share. I don't think it's fundamentally a good long-term story. There's not enough evidence to support that. But perhaps for the traders, the risk-reward definitely makes sense around these levels. And so hopefully they can get something right. At the end of the day, somebody has to provide the service they provide in South Africa. Globally, the chemical space, not so much. They could be overrun by competition. But in SA, there's got to be a fundamental business somewhere. But pick a number and trying to put a value on that. So it's not one we tend to own. We tend to be underweight, and we don't like the structural outlook. But if you want to have a trader's hat on, I think you could probably have a nibble here for short-term perspective.
All right. Before we go to a break, there's a question on Sibanye-Stillwater. Please discuss Sibanye and its prospects. I don't know. I kind of have a feeling that things are getting better for Sibanye. Chantal, what are your sentiments?
Well, fundamentally, it's a PGM business, right? So it's a play on platinum group metal prices. We have a structural deficit in that market, but the prices haven't really responded to that. But I would expect that we should start seeing a meaningful improvement in PGM prices over the next few months or years. So they'll probably have some structural tailwinds going forward in those businesses. The issue with that business for them is, particularly in the US, they're not run particularly efficiently, and there are some cost concerns there. They're also highly indebted, and then the gold operations that they have aren't really very efficient either, and they're having to close off shafts because they can't produce at a decent price, even at the gold prices where they are. They're future focused though, so they are looking towards expanding into critical minerals. They are investing heavily in that space, which is something that I like. But that's going to take years in order for us to start seeing a return on investment there. So I think it's a high risk story, mostly a play on PGMs. So if you like the PGM outlook, then this could be a nice one for you.
Yeah, it's really quite sad when a company cannot benefit from the tailwinds that are out of their control because of the challenges within the business that are in their control. Grant, your take on Sibanye-Stillwater and its prospects?
Not for the faint-hearted. I think some of the corporate, the capital allocation and some of these chasing these new metal deals probably wasn't done at the best levels or prices. The balance sheet is very much under pressure, and I think they're somewhat saved by gold at the moment as a bit of a windfall out of DRD and the operations, despite as Chantal said, perhaps the low quality of their operations. But having said all of that, if PGM prices rally, it's the most stretched, the most at the margin businesses that will rally the most. So you're going to get a high gearing to the PGM price here. Of course, they have sold a lot of their earnings forward through these streaming arrangements to fund and manage some of this debt. So it's not my preferred play in the sector. But if you do want to have a nibble, again, I think trade with caution, but you could get some racy upside if it comes off. But the downside is also there. Don't ignore the downside with that balance sheet.
All right. I do get excited when these companies that separated from bigger companies report. Of course, we have the darlings Boxer and We Buy Cars. Boxer was last week. This week, we have We Buy Cars. And actually, usually when they come out with something, the share usually does something significant. But actually, We Buy Cars basically did nothing today. Grant, I want to start off with you because it seems that things are still intact, or maybe all the good news has just been baked in.
Yeah, I think post the trading statement, this was pretty much in the price. The stock's close to all-time highs, 46 Rand, I think, somewhere around there. It's not cheap, but I think it's a really good business. The update was strong. I like the core metrics. The platform continues to go from strength to strength. I think selling more than 15,000 cars, I think they said 4 out of 6 months or something. And you know, this game that they're in is all about a network. It's all about that ecosystem. And they're building that out. And it's very hard to grow that. This is typically a winner takes most market. And they are very much in the front seat. So I like the business position. I like the platform. I like the management. I think they're doing the right things. If you take a long enough time, view, you can buy it here, even though it is a little bit pricey. Otherwise, wait for a better opportunity to get into the stock. But a good business.
Well, they're doing the right things even with their advertising. I don't know. I think they got the Nando's guy or something because their latest advert is hilarious. It's a play on refugees, Refugees. If you have not seen it, please go search for it on YouTube. Chantal, would you be driving into the stock?
Yes, I am still comfortable to drive into We Buy Cars. I think that they've just continue to deliver on the promises that they made during listing and even prior to that. They still operate in a highly fragmented market, so there's still lots of market share to gain from kind of smaller players in that used vehicle space. Importantly, the used vehicle park in South Africa, or the vehicle park in South Africa, continues to grow, even though you see volatility in new vehicle sales. And a lot of that is being fueled by an increased kind of focus on rather buying used than new, given some of the affordability challenges that we face from a consumer perspective in South Africa. So definitely doing the right thing. I think that they've actually, they can probably grow ahead of what the market currently expects them to grow over the next few years. So I actually think that even though it's trading close to record highs, the stock doesn't look expensive to me given the growth outlook. If you've got a company growing at 20+% earnings a year for the next 3 or 4 years, but it's trading at a 14 times PE, that's not an expensive stock to me. So as Grant also said, if you take a long-term view, We Buy Cars is still for you. Just an interesting factoid on the guys who are running with the campaign now. They used to do the King Price ads. So they did that bribe ad, I think, for King Price. So not the Nando's guys, but also a really exciting team working on that marketing campaign.
Okay, I knew there were brilliant minds behind that campaign. They really, really done a fantastic job. Well, let's take a look at the telecom sector. Vodacom also out with numbers. There's a growth, but what do you think about this level of growth at this point, Grant? Because from what I'm looking at, it's growth, but nothing seeming exciting. I don't know. What's your take?
Yeah, this telecom space is one that always struggling with, because you're always waiting for the fintech growth. You know, if you look at the numbers, the user growth, the GMV, it's significant, but you're just not seeing it come through in the underlying trajectory of the business. Then you look at, they have to spend 20 billion on capex in the next year. I mean, it's a capex intensive business. It hasn't changed from that perspective, and I just don't see the kind of returns on capex or on that investment that we'd like to see. Having said that, I think Vodacom is a good management team. They've got some improving tailwinds in Egypt, and some of that deflation is in the price. I think they're showing some good signs there, and of the sector, I think it's the one I like the most. And I think it's fairly priced. I think you can own it here, a decent business, but it doesn't excite me from a growth perspective and a kind of return on the amount of deep hole of capital they have to keep plowing into these businesses.
Yeah, just looking at what MTN had come up with the last week, and obviously we saw the different regions coming out with numbers, and I think they had a group update last week. Chantal, do you think that they're on the same level of growth as Vodacom? How would you compare these two?
So I think in the South African market, Vodacom has been the clear winner. But I mean, the market here is extremely competitive and quite mature. So it's difficult to get a really strong growth rate out of the SA business. For MTN, their biggest growth drivers will continue to be Nigeria and Ghana, specifically focusing on fintech and data. And for Vodacom, the biggest growth drivers will be Egypt, and then Safaricom via the investment in Ethiopia. So I think if you look at Ethiopia and Egypt, both are performing well, but they are facing the same issues that MTN periodically gets in Nigeria and Ghana, being currency devaluation, hyperinflation, and that kind of thing. So I think it's kind of it will be a more volatile story, but I think that Vodacom is a more steady executor when it comes to growth plans and investment. So, I mean, I still like Vodacom, but I don't think you're going to get fantastic returns out of it. I think it's a good diversifier to have in your portfolio, probably a little bit more defensive than some of the other companies in the consumer space. So it's got a spot there. It's just not sexy.
Well, another sector that is not necessarily considered sexy, well, you'll see growth, but never really exciting, is the healthcare space. But actually, the numbers from Netcare look pretty good, but that share price not really responding. Grant?
Yeah, this is a difficult space. If you think about in South Africa, there's a very limited growth in patients. So how many more people are joining medical aids a year? So their paid patients every year, that growth is very muted, and it's fiercely competitive. And the big medical aids are crimping down on their pricing power. So they're being told this is what you can charge for this procedure and this service. So they've got very little room to increase in pricing power. They've got cost pressures from underneath. And then you've got this massive regulatory overhang around the NHI. So for me, it's a structurally challenged sector. I find it difficult to get excited about the space, not because they're not the best management that could be in the space, but there's so many other challenges and things outside of their control that, I struggle to get too excited about it.
Chantal, your take on Netcare, but maybe just as the second part of my question to you, I know that you were excited about Life Healthcare specifically because of, is it their Life Molecular business? But I mean, now they've given away, is it control of it? I know that there's still something that they're involved in with that. Just your take on that as well. So just a quick comment on Netcare and maybe also Life Healthcare, and if there's a comparison between those two.
Yeah, I mean, so both of these companies heavily exposed to the South African the South African healthcare market that Grant already has highlighted is quite slow growth at the moment. In order for us to get a pick up there, we'll actually have to see a meaningful change in growth in South Africa, a meaningful change in employment, and therefore more lives under medical aid coverage. Yeah. For Life, the real growth vector was Life Molecular Imaging. And probably AMC to a certain extent, which they sold a couple of years prior to selling Life Molecular Imaging. So I'm struggling to see where the growth is going to come from. There's an area in renal dialysis which makes a bit of sense in that regard, but it is quite small. Netcare's growth vector is mental health, and I think that they can continue to execute there and probably give above market growth because of that. Unfortunately, Life has sold away their growth, but you'll probably get better near-term shareholder returns because of that, and they're now obviously quite cash flush.
All right. Well, let us get to your stock picks. Grant, what are you choosing today?
So I'm going with the stock I've picked before, but I'm picking it again. It's Alibaba. I think China is about 18 months behind the US in their AI adoption, and that cloud network is reaccelerating. The infrastructure as a service market is going to grow in the high teens over the next 5 years. I think it's a great business. They're sitting on about $80 billion of cash. I think that's about 20% of their market cap. It's still cheap by most metrics. Plus, they have about 900 MAUs on their retail platform. So, we've seen through the US companies that, and Tencent, these retail platforms are massively beneficial for advertising revenue. So they can use these AI tools to deliver much better ROIs on the ads and the ad revenue. So I think there's a lot of growth that's recovering in Alibaba, and I think it's going to give you some good returns for the next 3 or 4 years, and it's cheap relative to global peers.
All right. Chantal, where are you seeing value today?
I'm going to go with Pepkor today. So they had a really strong trading statement last week, and I had a look at the growth numbers relative to consensus, much higher than consensus for the full year. Also, I think consensus is a little bit too conservative for the next 3-4 years out. And if you account for that, the stock really doesn't look expensive relative to history. And if you further account for the fact that this company has a growing and very strong fintech offering that should probably demand a higher multiple, the core retail business is trading in line with like Truworths, but this is a much more defensive business and it's a high growth business. So Pepkor's getting my cash today.
Lovely. Well, thank you so much for your time, guys. Really, really appreciate your analysis today. And that is all for Stockwatch today. Thanks to our guest Chantal Marx from FNB Wealth and Investments and Grant Nader from Benguela Global Fund Managers. Up next, The Close. Stay watching.